Welcome to the short executive knowledge lecture on topic 2, paper 12 of the SFC licensing exams. This topic covers client objectives and the products available. And as you see on page 2.1 in front of you, we'll be looking at identifying clients' investment objectives and constraints. We'll then look at the main asset classes that are available to investors, and topic 2 will finish with the major types of managed funds. I will emphasize the important points to help you understand the core material you need to know to sit the exam, and a copy of the study notes you see on the screen can be downloaded from the Executive Knowledge website under Resources at the top of the main page. As ever, I strongly recommend that you supplement this learning with question practice that is provided on Examinator.online under HKSI Paper 12. Let's start. Top of page 2.2 in identifying client investment objectives and constraints. And we're told that before investment takes place, following question needs answered. What are your investment objectives and constraints? Now, what are the objectives? There are two objectives, and they are the first 2 points on the list: return requirements and risk tolerance. That's your objectives. You want a return and you want to maintain a certain level of risk, and we'll be covering those much more later. And then there are listed here 5 constraints: investment horizon, how long are you willing to invest for? Tax considerations, what is your tax liability on certain income? Liquidity requirements, how quickly do you need cash? Legal restraints, what you can and cannot invest in legally, and your own unique preferences and needs. Also, clients' circumstances do change over time, and we'll be looking at the life cycle of an investor's requirements. Moving on to investment planning, an investment consultant will want to draw up or advisor will want to draw up an investment policy statement with regard to clients. Reasons why an asset manager should construct such a policy for clients, well, they're listed, and this is the easy sort of questions that could pop up. A policy statement helps state goals and objectives, provides a valuation system for benchmarking performance, sets boundaries for strategies and product purchases, how far you can go, helps communicate the investment policy, especially when there's a dispute or change in fund manager. So it gives you guidance as to what you should be doing because it was thought out at the beginning. Statement, the investment policy statement should include statement of purpose, investment objectives, this is really the sort of chapter headings, roles and responsibilities of investment managers, and investment guidelines and boundaries. Now, the objectives should indicate medium and long-term performance targets, the benchmark, that may be a particular index, and return performance and asset allocation strategies for each asset class. And we're going to be looking at those in a moment. The guidelines and boundaries, they should indicate the investment choices that are prohibited, and the investment vehicles tactics that should be avoided because of the investor's requirements. Estimated maximum permitted loss should also be included. So an investor should come up with the maximum loss that they would still be comfortable with. And obviously that is a very personal aspect. Now, when an advisor is considering a client's requirements, we'll want to know about the financial position of the client, their income, their asset position. Typical questions that can be asked: do you have any liabilities or planned future expenditure items to meet? Children's education, a classic example. Are you earning surplus income? And if you are, well, how would you like to invest it? How are you funding or planning to fund your retirement lifestyle? So these are upfront questions to learn about a client's financial position. What about risk tolerance? Now, risk tolerance can range from very conservative, I don't want to lose any money, in which case you're just going to put it in the deposit account, to aggressive, where you'd be looking to invest in high return stocks. You'll consider clients' attitude to risk. That's very personal and subjective. Personal background, investment experience and knowledge. Are they new to this? And the stage in the investment life cycle, which we will be looking at in a moment. Now, when you establish a client's level of risk tolerance, you should take into consideration the client's views, their own personal opinions on losing some or all of the capital. And if that's just not something they can contend with, then you got to take that into consideration. Their views on earning a negative return. Are they comfortable in the long term that there will be negative returns and hopefully positive returns that outweigh the negatives? Earnings less than inflation, is that a problem? And substantial swings in investment value. If a client is uncomfortable with substantial price swings, then you're not going to go for risky assets. Client's personal background, their investment experience, their knowledge should also be considered by the advisor, including their attitude to, or rather their current diversification of investments, interpretation of investments, past performance. How do they view the past performance of investments? That will give you an inkling as to their attitudes and their ability to set and adhere to a budget. Do they have the discipline or any other investment goals? Now, we come across the concept of human capital, and this does get examined. It would only be one question. So when you're determining investment strategy for a client, the wealth manager should consider this idea of human capital. What is that? The ability to earn income in the future. So it's you have capital assets. Well, this is the person themselves. Human capital. Can they earn in the future? It can be measured as present value or future labor income. Well, present value, that's when we discount back. Two concepts related to human capital, and this has been examined. The hedging effect. More stable a person's future regular income, the more risk can be taken because you know that there will be future earnings coming and they're pretty certain. So it adds an element of diversification. Classic example would be a university professor who has tenure and is going to be working for another 20 years, almost guaranteed. That is the hedging effect. Labor supply flexibility, the ability to work overtime, for example, for extra pay. And that allows the client's portfolio to be a little bit riskier because if they lose money, well, they can put in for some overtime. So two concepts behind the idea of human capital, the ability to earn income in the future. Now, digging a bit deeper into investment constraints. I touched on these earlier. We had liquidity, investment horizon, tax considerations, legal considerations, and your own unique preference and needs. And we've given you just more detail on those. So those are constraints on how investments can be made. And we've added at the bottom life stage considerations. So that the stage in your life will influence investment requirements and decisions. And each person's experience at a particular stage of life is unique. We're not all the same. Let's look at a table that summarizes the investment life cycle stages. First of all, people that are single and employed, and the guidance is between 15 and 25, they'll have their first job, they'll have income, they'll have rent to pay, they'll have the first credit card. Now, not everybody has this, but we're looking at the sort of typical example. You may have surplus income, but your term horizon is very long. Then stage 2, family nest, 25 to 45 years, generally. There, you could be married, children, you have a career. There, you have a need for life insurance. You want to prepare for a will, and you'll be living on one income. Well, obviously, this is assuming a whole host of factors. Couples may be living on 2 incomes, or it may be a one-parent family. Who knows? But these are just guidance. So you've still got time to earn, but you have got you've got liabilities, you've got commitments that you must pay for. Then we move on to 45 to 65 years old. Family can be shrinking, children leaving home. You could well have two incomes. Your liabilities are paid off, possibly. Your mortgage is paid off. You could be caring for aged parents, and you'll be into serious retirement planning. So you still be looking to invest for longer term. But once we retire and we're giving the age of 65 plus, then you're looking to benefit from your pension, which you'd be paying out. You're looking for retirement income. You'll have expenditure, travel plans, health requirements. Now, each of these different stages, individuals will have different investment needs and requirements. Implications for the investment strategy of managed funds. Well, we have strategic asset allocation and tactical asset allocation. Strategic is looking at the longer term. So this would be for the earlier stages of the life cycle, at least 5 years. Asset mix should be driven by an assumption that markets are efficient. You're looking at the longer term, so the prices will stabilize in the future, maybe short-term blips. Usually you're going for a constant mix of weightings of asset classes. We're told 5% deviation from the benchmark weighting. That may trigger portfolio rebalancing with strategic asset allocation, and a very early step to advanced allocation strategy to exploit market timing and pricing efficiency. This is the initial planning. Longer term, strategic. Where are we going to put the assets? Equity, bonds, property, whatever. Very early step to, I beg your pardon. The last point, it requires selection of appropriate investment management styles for sure. Now, in contrast to strategic asset allocation, we have tactical asset allocation. This is much shorter term. Dynamic strategy, you're looking to enhance returns where there is opportunities in the short term, where you have managed to get lower risk or both. It allows fund managers to trade aggressively, make frequent shifts in asset allocation. Some clients will be comfortable with tactical asset allocation. Others may think it's too risky. And overall, diversification, very important at paper 12. Through portfolio diversification, we're looking to maximize returns while minimizing risk, and we're going to look at a diagram for that very shortly. Benefits of diversification are increased when investments have low return correlations with each other and they're combined. What does that mean? It means that the returns, let's say, of two investments move in different directions. So when one investment's returns go up, the others goes down, and vice versa. So that whatever happens in the market, your combined investment stays steady. That's the idea. And you can have highly correlated returns and low correlation between returns. And that is the basis for optimal asset allocation by looking at the efficient frontier. And the efficient frontier is shown in the diagram, the top of page 2.6. And in the next section, I will go into what this diagram tells us and how to interpret it.